Okay, let's answer some questions from the last market outlook. As you can see in the top corner, 124 comments. I don't know if we'll get to all of them, but let's see what we can get done. I previously asked a question on using ES for passive equity exposure. Given that it's based on the index, would dividends not be accounted for in the forward price? Dividends would be accounted for in the price of a forward, because the forward price for a futures contract is going to be whatever the spot price of the underlying is. We'll be using continuous compounding here, R minus Q to the T, Q being the continuously compounded dividend yield. So if there was no dividend, you can see that it would just be R. If the dividend yield were 0, then the futures price would be the highest it could be. But as soon as you subtract Q, you can see that the futures price is going to be lower. I also noticed that CME is about to launch a total return swap futures contract for the S&P 500. Now, swaps are different than futures. Futures are based on a no arbitrage price. Swaps are based on a return series. So if you're just looking at price and not dividends, and you're just looking at a price return, then you're not getting the full return. There you have to distinguish between a price return and a total return. I also noticed CME is about to launch total swap futures contract S&P 500. Given this, I'm wondering if using ES is inferior to SPY. It's probably going to be the same. Because look what you have going on here. The futures price is higher by the spot price by the interest rate. If you have a swap, you're basically looking at a spot price. You're going to be swapping the equity return for a floating rate. ST for a floating rate. Well, there's the floating rate right there. So your negative carry, because your futures price will be above the spot price, which means the spot price has to rise to the futures price just for you to hit break even. Well, that is your pay floating. So it's basically the same thing, except when you enter the swap, you're entering it at whatever the spot price is. The futures contract has the pay floating implicit in it, whereas the swap has the pay floating that is explicit in it, but it would be the same thing. I think the benefit of the swap, depending on what TRIZ does, I'm not familiar with it, but maybe it might use an ongoing swap, and if it does, then there's no need to roll over futures contracts. So it might have a 5-year, it might be set up with 5-year swaps, in which case you don't have to keep rolling over futures contracts. With futures contracts, once you go out to the third one, you know, the front month is liquid, the second month is kind of liquid because they're quarterly, right? But once you go to the third month, you're 9 months ahead, you kind of lose liquidity there. Is there a general rule on when an ETF authorized participant works to move share baskets to get price closer to NAV? When it deviates from NAV by a certain amount. So the authorized participants know what net asset value is, and they can monitor the creation basket. There is a basket of stocks every day that's provided as a creation or a redemption basket, and the weights. So the authorized participants know what the value of the creation and redemption basket is, and they can monitor it against the net asset value of the ETF. And once it gets out of line enough that it covers the transaction costs of getting it done, then it gets done, which forces the prices to come back into line. What are you thinking of using for Canadian bond exposure? Are you targeting specific duration? You just get as long duration as you possibly can. I don't think Canada has 30-year bonds. I think they have up to 25 years. Canadian fixed income ETFs have MER so much higher than the American counterparts. They do. And CAD treasuries aren't really available to retail investors You should be able to buy Canadian government. Any investor should be able to buy government bonds. It would be, I think, a difficult thing for a government to do to deny the ability of a retail investor to buy government bonds. You're going to need a dealer for that, but most brokers have a dealer desk. Would you think there could be a pairs trade on XHBITB? Not really. Not anything that would be exciting. I think the spread would be so thin, and why not just be long only on this one, right? It's not like one will go up and the other will go down. That's where you want to do a pairs trade, is where you have one strong and one weak. These are both strong, just one will be stronger. If you are trying to be sector neutral, then yeah, you could probably do something like that, and then lever up the difference in the spread. But on this one, I think being long, just being long. I was wondering whether you use econometrics for analyzing the market and stocks. No, I don't. I've been learning a little quantitative analysis to study the relationship between macro and market variables, and would like to hear your thoughts on its utility. Any relationship that can be found or could be found has been found. The number of analysis, the number of funds out there, and the number of quants, and the amount of analysis being done, you're not going to find anything that's going to be surprising. If you're doing something like this and you're looking for something that is new or interesting, you have to have a theory or a thesis as to what it is first, and then you'll see if there's anything there. But if you're just looking at very common relationships you'd expect to find in textbooks, you'll find support for what you'd expect to find in textbooks. That doesn't mean you found anything. You found something that a fund somewhere that is running an ETF that has exposure to that particular factor is already found. So I don't know that there's much value in it unless you're doing it for a reason. If you're doing it to explore the possibilities that you might uncover something, I don't think so. I don't want to discourage you from it, but if it is what you're going to do, then do it. But if you're looking at it saying, I wonder if there's anything under that rock, unless you're really going to dive deep on that stuff and really not just surfacey stuff, because that's already been done. All the low-hanging fruit has been picked away. You have to be, I think, very good at it, and I think the amount of time that you put in it is proportional to how important it is going to be to your career. Also, how helpful is financial modeling valuation? Accurately predicting stocks? Not useful at all. The word, if you're saying how useful is it? Well, it's useful not for the price that you're going to get. It's useful for understanding the company at a deeper level. The price you get is based on a mountain of guesses. But you have the word accurately predicting stocks. Nope, not useful at all. Completely useless. There is nothing that accurately predicts stock prices. Nothing. I can't even say that enough. Nothing. I can see it being useful for painting some broad strokes, but I'm not sure how accurate a target price. It's not accurate. It's not accurate at all. Let's see. Costa Rica. Once you've been deemed a non-resident by CRA, for me, that's January 18, 2024. Will you spend any time in Canada? I am allowed to be there for 6 months less a day and still maintain non-resident status. So I can still visit Canada. I mean, foreigners can visit Canada without ever becoming a citizen or a resident of Canada, but there is a limit. You must be 6 months less a day. I'd also like to know what you've done for health coverage down there. You can get coverage down here. Private coverage, pretty high-end coverage for about $5,000 US dollars. Fairly comprehensive. Your deductibles, depending on what you're doing, are anywhere from $500 to maybe $1,500. There are limits for certain expenses, but it's fairly comprehensive. for someone who really has never used the healthcare system in Canada since he was, I'm talking to myself in the third person here, since I was, I think, 26 when I had walking pneumonia. There I had to go to emergency because I could barely breathe. I mean, it just your lung is filling up with water, and it's just you're breathing shallow all the time, and you just can't even sleep. I went to the hospital then. I've not used the healthcare system since. So, you know, the deductibles for me don't seem that egregious. Besides, you never give up your Canadian citizenship. If it comes to the point where healthcare is going to be extremely onerous, I just have to move back to Canada. I'm always a Canadian citizen. As soon as I get back, I just have to say, look, I'm a resident again, and you know my taxes would start. But there you go. However, you got to take the good and the bad. Yeah, it's free, but you wait and you wait and you wait. Here, it's not free, but you can get it tomorrow. It's, you know, your choice, right? If you had a speaker series anywhere in Canada out of 10, I don't know. You see, I've thought of this before as, you know, what could I do in person that I can't do online? And I can't come up with an answer for that. So I don't know that I'd ever do an in-person event. Going through your site content at the moment, I was hoping you could talk a bit about where we are in the credit business, the credit cycle, and how you come to that conclusion. Well, I think for that you could just look at the SLOOS, the Senior Loan Officer Opinion Survey, and most of them are not really expanding in terms of credit availability. So I'd say that we're late in the cycle. Certainly, it's not contracting. Now, some loan officers are reporting that they are not increasing or decreasing in certain areas. So I think it's not economy wide, but if we're looking for where the credit cycle is sort of in a contraction right now, most definitely it would be commercial real estate that is in the that's sort of in a downturn. Let's see, I know in the CFA level 1 curriculum there are points about leading, trailing, and concurrent indicators, but I'm having trouble using that knowledge and piecing together it all to identify specifically where we are right now. Yeah, so the higher rates go, the later in the credit cycle you are. Once you read the Senior Loan Officer Survey, it tells you whether they're expanding credit, keeping it about the same, or constricting. In other words, their loan growth. You can read banks' 10Ks or 10Qs, and they always report loan growth. Current thought is that we are in the slowdown contraction period. Slowdown, yes. Contraction in some sectors, yeah. There's always talk about how the recession hasn't come yet. Well, it hasn't. We know that. Or is it that the contraction can happen without a recession? No, I don't think so. Let's see. Communication services video to be completed and posted. Already begun the research part of it. Research usually takes about 2 weeks because you really gotta keep going and going down these rabbit holes. And then when you're done your research, then you have to sort of pull it back a bit, saying, okay, I went too far here and I went too far there. But you have to go further than you need to make sure that your understanding of the core is good enough. So when you're researching a topic, there is some core knowledge that you're going to need. And if you just stay within the core, you never really know if you've got it all. So you have to go further than what you need, and then you pull it back. And then when you're doing your final notes or your screens, you pull it back a bit, just to make sure that you have a firm understanding of the core. I know when I'm done, when I'm not learning anything new. So when I read something and I go, I've already seen this, I've seen that, I've seen this. If I'm not, I'm on the 100th reference or the 150th reference and nothing is new, then I'm done. I'm ready to consolidate. 2 questions. Do you have any expectation about when BOC will start to cut? Tiff Macklem, I think 2 days ago, said he expects to start cutting rates in 2024. Whereas the week before he said, I'm not even thinking about cutting rates. A couple days later in an interview, he says, I expect to start cutting rates in 2024. Well, there you go. When will they cut? He says 2024. Tiff. Let me write that out for you. Tiff is his name. Tiff. Tiff says that he'll start cutting rates in 2024. I was expecting BOC to be one of the first big central banks cutting the current evolution of GDP and the good numbers in Canadian inflation. Yeah. And do you know any ETF for longer duration Canadian bonds? No, I'm just not a Canadian market person, even though I was Canadian the whole time. I'm just not a Canadian market person for long duration bonds. My thinking is it's easier just to go out and look for a low coupon long duration bond. And you should be able to find low coupon because a whole bunch of bonds were issued, 25-year bonds were issued when rates were really low, 4 or 5 years ago. So you'll find a 20-year bond. It should have a very low coupon. How we get credit premiums from corporate bonds, you can just go to Fred. If you Google Fred high yield OAS, and then change that to IG, then change that to AA, then change that to triple B, then change that to double B, then change that to triple C. Each time you search, and you'll get the OAS. Also, what does the spread between interest rate swap and government bond yield represents? That's a swap spread. They're both par curves, right? So if we look at a government yield curve, let's just draw a simple one out, and it looks like that. That's a par curve because each yield is what a coupon would have if a bond were issued that day at par. And you can draw out the swap curve, which would be very, very, very close. Maybe a little bit of a spread between them. That spread and the swap curve is an interbank rate, which is also a par curve. All swap curves are par curves, and all par curves, well, other than your government par curve, all swap par curves can act as a swap curve for the fixed rate and the swap. The difference between the two would be the swap spread. Or, let's just call it the swap spread. Watching your applied options series, I have a question about determining the price at which you sell your options. Generally, I like to earn approximately 20% annualized return on the requirement for the option strategy. However, I notice that when I apply some of your volatility strategies, I don't always get this yield, particularly on QQQ and SPY. Well, a lot of the volatility is simply gone. If you've looked at implied volatility, look at the IVP, the implied volatility percentile. The volatility today is the lowest, like you're at 0% on the percentile, meaning all measures of volatility have been higher than what you're looking at today of the implied volatility. So there just simply isn't any premium in them. So if you're noticing that you're not getting the return, you're right. Without implied volatility, the return sucks. The return's really low because what it's saying is that, hey, there's no risk here. Implied volatility is very low. There's no risk. You don't need a lot of return when it has low risk. Am I thinking about this incorrectly, and are my expectations too ambitious? No, they're not. It's, you just have to understand there are going to be times where there's no premium in the options, where selling on the index, selling options on the index suck. That doesn't mean that everything sucks. It means you got to go looking for an underlying which has a slightly higher implied volatility, something in the 20s, 25 to 30. And you can get some premium there. How do you typically determine if the premium you receive for selling options is sufficient? Well, I mean, I can see the amount I get and how much margin I have to put up. After a while, you could just eyeball it and say, like wait 45 days, put up that much capital for that. I can do better in the T-bill, right? So it's, you just eyeball it. Let me see if I can give myself a little more room here to read this. Wondering about liquidity on strips in IBKR when I place an order with limit above the ask. So okay, I see when you're okay. Yeah. Or if you're using market order, it takes hours to get filled and sometimes does not fill. Yeah, it depends on what kind of strips you have, right? There are interest-only strips and there are principal strips. Interest-only strips have low liquidity because it's the interest only. So there might be only, 2 million of par value out there in the interest-only strips, and some fund somewhere is sitting on all of it. And maybe you got a couple of bonds out of it, but somebody somewhere is sitting on all of it. So you're going to have to, offer something a little bit more, I think. But yeah, if you have the interest-only strips, very low liquidity. No issues on coupon paying treasuries is due to my small trade, 60K in face value. It's probably, if you look at the strip you have, it's probably an interest only, and no one out there that's holding it has any interest in doing anything. It's probably the case that no one's even looking at that. So, the dealer is posting a bid in the ask, right, and it sees your order come in, which is ahead of the market. The dealer has to be willing to hold inventory, and maybe the dealer, because it is a dealer market, maybe the dealer doesn't want to hold inventory on something. According to your portfolio construction videos on news, I did subscribe to the notification, but the emails are always received after a lag of almost 5 to 8 minutes. Some are really slow. Sometimes I can get them a little bit faster. They used to be much quicker, but I think with email servers, from the time that it hits the site, it starts going out. If you watch when you get it, sometimes it's earlier, sometimes it's later. I'm not sure what process they use on their email server, if it's by time zone, if it's sort of a maturity thing. Those who have been subscribed the longest get it the soonest. I'm not really sure on that, but yeah. But you can always get this information by just going directly to the site if you know that it's available that day. But you'll have to hit refresh a lot around 8:30 when it's released. Even then, you have to get it, download it, read it. The market's already way ahead of you on that. Let's see, and will there be any new videos added to portfolio construction? Yeah, there's more coming. It's just a matter of finding the right conditions to get it done. It's sometimes you want to show something, but if you don't have the market for it, you're sort of forcing it to happen, and it doesn't make the point very clear. I've put a lot of stuff up. There's a lot that should keep you busy. And then it's just a matter of finding the right conditions to add more. Usually you can do a bunch of stuff, and then after a while you have to sort of add stuff opportunistically. Is that when you have a particular thing happening, it's like, okay, now we can show something here. But yeah, there are more coming. If we're looking to capitalize on the projected rate cuts, assuming a time horizon of a few years, is the best way simply to load up on financial instruments with the highest sensitivity to interest rates? Yeah, I would say yeah, but you got to be careful. Some things have a high sensitivity to interest rates, but also have a high sensitivity to other things. So if rates get cut because the economy slows down considerably, and you're in something that has interest rate exposure and market exposure, there's no guarantee your asset is going up. So you want to try to keep it as pure as you can. For this specific strategy, would purchasing SPY be suboptimal compared to purchasing long-term zero coupon bonds? Yeah, I think if you're betting on interest rates dropping, the purest play is the long-term zero coupon bond or very low coupon bond. Also, would it still be sensible play to purchase long-term bonds now at current par rates? Well, as I do this on the Wednesday, the market had a really big pullback, started about 130. If you were watching the market from 1 to 130, probably was the most boring thing you've ever seen. It's like watching paint dry. SPY would go up 4 cents, would come down 2 cents, would go up 3 cents, would come down 4 cents, and volume just disappeared. After 9 days of buying, there just didn't seem to be any buyers left. The question was, will there be profit taking? It seems that there should be. I did last week. I mean, it was a big run in REITs, in the Canadian apartment REITs, and I said, wow, you got to take profit if the market's going to hand it to you this fast, you got to take the profit. I'm glad to see that the REITs are all lower than when I sold them, so hopefully a couple more days like this. Maybe it's, this is the last full week of trading before the holidays. You have a shortened week next week, a shortened week the week after. Maybe there is a desire to lighten up and take profit before the weekend comes, because I think a lot of firms and traders may have a very light week next week. A lot of portfolio managers may take an extended vacation and just lighten up for the rest of the year, tax loss harvesting for the rest of the year. But this is the week. By the way, if you're into the technicals, this is what's called a Wednesday reversal. Is when you have an up day on Monday, up day on Tuesday. It's very common that if you're going to reverse, it reverses on the third day. It reverses on a wednesday. It's same if you have a down day. Monday is down, Tuesday is down, Wednesday is down. It typically will reverse into the close. It's just called I don't know if it's called a third day reversal or a Wednesday reversal, but it is I wouldn't say quite common, but it's common enough that it has a thing, that it's a thing, right? 2048 bonds you loaded up on, will be holding them to maturity? Probably not to maturity, because there will come a point, I believe, in the next couple of years where interest rates have fallen enough that the yield that would remain wouldn't be that exciting. I may as well take the capital gain at that point in time and go into something more exciting. But not till maturity, but I wanted duration. I wanted more duration than TLT would provide with a higher yield. I find it difficult to sell puts on DHI when it's now at 150. Yeah, I know what you mean. And continue to make all-time new highs. Yet waiting for pullbacks has also been quite costly in terms of opportunity cost. That is true. As they say, it's time in the market, not timing the market. Yeah, it is. What would be your approach to accumulating DHI shares now? You have as I saw this morning, the 30-year fixed is now down to 6.83%. So the housing stocks will be well supported. You had housing starts that were up 14.8% yesterday. That's huge. To have that many starts sort of suggests that the home builders must have had orders, because why would you have such a big jump in starts? Interest rates are too high to build to inventory, so it must be orders. I seem to think that home builders will be well supported for a number of years, but I know what you mean. It is difficult to sell puts when it's at such elevated levels. You mentioned a lot of long ideas recently: TLT, XHB, NBS Utilities, Copper. What would be your highest conviction out of these next year? Highest conviction next year? Duration, period. Duration would be my highest conviction next year. And that would also mean utilities. If I were going into equities, utilities would be my highest conviction because they are duration-like. They are very bond-like in their cash flows. Plus, they have an asset growth that is going to be in the mid to high single digits, which is pretty good for a utility. So you can expect the dividend growth over a number of years. And good support on the price, good yield, and good price appreciation. So those two, I think, are easy decisions. But if you're 25, I don't know that you really want to hang out in utilities, right? I'm looking for things that would do well in both a soft landing and in a recession. Tech seems to be the only thing that makes sense right now. Communications does very well. The media companies do very well. So Meta, Google, Microsoft, Amazon, they tend to do very well. In a recession, they're still going to get hit, but not by as much. I'm wondering if small caps, Russell 2000, will have more room to run given they're further off their all-time highs. Yeah, they are further off, but justifiably so. I think you have the highest percentage in the Russell 2000 that are unprofitable now. The highest percentage that are unprofitable. And they're probably less capable of managing their interest rate charges, less capable of perhaps rolling over their debt if credit or credit availability in the high yield space doesn't improve. Well, it doesn't improve. I mean, I don't know that it's deteriorated, so maybe scratch that. Oh, that's a good question. It's certainly not going to perform, I think, as well as large caps with elevated interest rates. If interest rates start coming down with a good economy, I can see small caps from that point beginning to outperform. But yeah, I think you have to wait for the interest rate cuts. Let's see. Where did we leave off? Is QT and Treasury issuance still an important factor in bond pricing? QT, I don't think ever was. There was always talk about it, but it goes on every single month. It's been going on for the last 1.2, 1.3 trillion, and you don't really hear much about it. I mean, it's there, but I don't know that it's like a small running little stream. You know it's there, but it's just not causing any damage, right? And no one's really paying attention to it because it's not a torrent. And as far as Treasury issuance, when something happens for a period of time, initially it might be shocking, but you just get acclimated to it. I mean, does the market even care about the war in Ukraine anymore? I mean, does it? Not really. And when the war first broke out, I said the longer this goes on, the more it's not going to matter. It'll just be background noise. And right now it's just background noise. Same with Israel and Hamas. I don't want to say they're at war with Palestine. They're at war with Hamas. But the longer that goes on, you could say, well, it's been going on since how long, right? But the longer it goes on, the more it becomes normalized, the less it really matters. So with Treasury issuance and deficits as far as the eye can see, the longer it goes on, the more it becomes normalized, the less it matters until it does. And what day is that? I don't know. What good news could take us higher? I think we've got all the good news now. You've got a Fed that is on pause. You've got Powell that is sort of clearly waving the white flag saying, okay, here we are, this is it. It would be a difficult task to raise rates more at this point in time. I think they're on hold. The question is, when do they start cutting? I think we've had our good news. I think the only other thing that you could have is a significant ratcheting up of earnings expectations. You may get that in 2024 if AI starts to begin to deliver on the bottom line, in terms of efficiency and in cutting costs. You may get some ratcheting up of earnings expectations, but I think that would be the thing I'd be looking for. Do you think the end of the bank term funding matters? Not really. How many times have we heard the banking system is sound and resilient, and there's plenty of liquidity with rates on the mend and expected to be cut 3 times by the Fed next year. The unrealized losses sitting in bank treasury holdings are going to disappear. So I think the worst is over. And if banks, after last March, if banks haven't gotten in line, then they should be allowed to fail at that point. Understand that you focus on U.S. market. Are there currently any foreign market risks that are in your radar that may pose a risk globally? Well, China's always a risk, but here's the deal. You have the rise of India, and I think that will continue, and I think that's going to be just as big a story as the rise of China. So if you have, a race and you have a horse in first place, and that's the U.S., and you have, three other horses back here. You have China, you have Japan, and something else, and you have a horse coming up, but one dropping back. The pack is still there. That the loss of one is replaced by the gain of another. So what China doesn't order in copper, India will probably start to pick up in its orders. So. I don't think so. No, there's nothing really. Here's the thing about these things. If there is something out there, it tends to happen overnight. Something, a slow-moving disaster is usually taken care of, because you can see it coming. So little by little, everybody starts to work to make it better. In their own way, everybody tries to move a little bit this way, a little bit that way, because humans are strategic. If you tell them somebody's coming to kill them, they'll run and hide, right? It's when people show up in the middle of nowhere. That's when it becomes a problem, is when you have an external event that just happens in the middle of the night. Anything that is on your radar, anything you can identify saying, but what about this? Well, if you know about it, so does everybody else, and everybody's not going to stand around and just let it happen. There are people who don't want to see it happen. There are vested interests on the inside that don't want to see it happen. There are negotiations that happen all the time. There's actions and strategies being undertaken all the time to avoid the worst possible outcome. Can you explain a little more detail why real yields going down matters to QE? Because it's real yields that matter to whether monetary policy is tight or loose. So if you have inflation that is, let's say, 4% and a nominal yield that is 4%, company cash flows are increasing 4%, discounting it back at the same 4%, great. But if you got to discount it back at 6 or 8 or 10, well, that's the difference between inflation and the yield is the real component. The higher the real component, the more restrictive monetary policy is. And Powell said in December, we are in restrictive territory. Well, if real yields start dropping, that is taking monetary policy out of restrictive territory and into accommodative territory, and that may cause the Fed some concern, saying, hey, we don't like the move in real rates. So a drop in real rates, a drop in nominal rates is okay. If nominal rates go from 5% to 4% because inflation went from 4% to 3%, there's a 1% real rate, there is still a 1% real rate. You still have a 1% real rate. So if inflation is dropping and nominal rates are dropping, keeping the real rate constant, you're still restrictive. It's when the real rate starts dropping that you start to then reverse monetary policy. So they may be more concerned with real rates at this time, right? Let's see. Can you also give some insights as to how bond issuance can be bullish, bearish for equities? Well, I think you said it. It could be bullish or it could be bearish. You tell me what's going on, and I'll tell you if it's bullish or bearish. But to say is issuance bullish or bearish, I don't know. Why was debt issued? You tell me why it's being issued, and I'll tell you if that's bullish or bearish. But it could be either one. How lower, higher coupon rates, higher bond issuance of a certain term can affect the market. You tell me what bond and what coupon and why it was issued, and I'll give you an answer. Right? There is no if A then B when it comes to this kind of thing. It's give me the context and I'll give you an answer. But without context, just saying this, if this happens, what would happen? I don't know. When this happened, what else was going on? Why did this thing happen? You tell me why that happened, and then I'll have some answer. But other than that, I don't know. Beats me. I would answer it this way. Tomorrow, equities may go up or they may go down. And that's the best answer I can give you. If more bonds were issued, what would happen? Well, either rates would go up, yields will go up, or yields will go down. And I'll be right. They'll either go up or they'll go down, but I don't know. Nobody knows. Give me a context. Give me a context and a reason why, and an amount, a relative amount compared to what was done in the past, and maybe I've got the probabilities on my side to say this is most likely to happen. That's the best that this game can offer you. I'm a noob, so not sure if I correctly phrased the last question correctly. Few questions. I'm quite surprised at the market's reaction. Recent FOMC, given the target rate implied by the Fed funds futures, has been placing 95% probability on hold since last FOMC. Yeah, it wasn't the decision. It was the press conference. It was Powell saying we had some conversation about rate cutting. We are aware of the problem of leaving rates high for too long. We are aware of that. So it was that he was extremely dovish in the press conference that did it. Nobody expected a rate hike. Any intermediate concerns on the significant moves to the upside on both fixed income and equities? It was a lot really fast without the economy getting better. In fact, fourth quarter GDP is forecast to be lower than third quarter GDP. GDP for 2024 is forecast to be lower than GDP for 2023, and earnings expectations are pretty flat. So it didn't change the economy and it didn't change earnings. So you can only get so much out of that run, right? It's more of a relief rally that, thank God, the rate hikes are over, and now we can start looking forward to the rate cuts. The question is, when's the first rate cut? Okay, great. Let's put some money to work. But it was a lot really quick. You're due for some kind of, you can't just keep going up every single day without the rest of the game coming along with you, without the economy growing and without earnings growing, right? Are Fed funds futures a poor measurement of investor sentiment? They're not a poor measurement. They're just not a very exact measurement, because the Fed funds futures are used for hedging purposes. So in calculating the probabilities of rate hikes, it's not always just sentiment that's in the futures. There is some technical aspect to the Fed funds futures, in that they are used for hedging. So there'll be some price movement just because of that. That does not mean that there's any idea that there is a higher or lower probability of something, other than, look, I got to use this for hedging, and this is the price. Since U.S. debt to GDP is still significantly high, and the Fed's SEP stating 2 rate cuts next year, 3, wouldn't a decrease in rates be problematic for attracting foreign capital? Couldn't this put pressure on our ability to roll over our debt? No. Any bank that is sitting on U.S. reserves has to park it in something, has to buy something. Insurance companies, life insurance companies, have to buy something. Banks do have to buy treasuries. Pension funds do own treasuries. There'll always be buyers for treasuries. So no, I don't know that they'll have trouble attracting capital. Considering post-pandemic landscape, perceived normalization in various sectors, I'm curious about your perspective on cruise liners, particularly CCL. Is that Carnival? I noted the negative peg rate. Well, the only way you get a negative peg rate, you'd have to have negative growth to get a negative peg ratio. Growing revenue, net income, and substantial long-term debt. Well, if you have growth in revenue and net income, how do you have a negative peg ratio? The PE is your numerator. There is no negative PE. G is the only thing that can turn that ratio negative. So it must be, if you have growing revenue and net income, then you cannot have a negative peg ratio, unless you mean a peg ratio less than 1, and you're calling that a negative. If it's a peg ratio less than 1, that would indicate undervalued. Substantial long-term debt. How would you approach a deeper financial analysis? I'm not big on cruise lines. I don't get the allure of cruise lines, but that doesn't mean they're not a business. I just don't understand enough about cruise lines to give. I don't know what their margins are. I don't know, one good company from another. I know nothing about cruise lines, so I wouldn't have an answer for that. How would I approach a deeper financial analysis? Well, I'd learn about cruise lines. I'd want to understand everything there is to know about cruise lines. Then I'd read all the 10Ks for at least 3 or 4 different cruise lines. I'd read their 10Ks because I'd learn a lot about the industry from the 10Ks. And then I'd see where my journey would take me. But I certainly wouldn't do anything without knowing anything about cruise lines. In other words, I wouldn't make any bet on any cruise line if I didn't know anything about cruise lines, because I wouldn't know when to get out. And that's a problem. I'm now studying CFA Level 1. When I came through economics section, business cycle reading, based on what I've read in the current economy, you were at slowdown phase, right? I would say yeah. And after that, it should be contraction. Well, contraction can follow, and that would be called a hard landing, or recovery and growth can follow, and we can forget contraction, and that would be a soft landing. But based on the Fed action soft landing to prevent going to this phase, what will happen if they actually manage to do so? Then we would see a recovery and then growth. Like what would be the next stage will be recovery. Well, actually, it's kind of hard to say that you'd have a recovery if you don't have a contraction. If you just have a slowdown, you're still growing, so you still haven't hit the peak in GDP. It has not contracted. So recovery would be meaningless. It would be just the next expansion. Call it early expansion. Would be in should we go to non-durables for the paper account, or was the appropriate reaction? In early expansion, you'd probably want to be in anything that is cyclical. Yeah, non-discretionary. Discretionary would be probably an outperformer, along with QQQ. That would be an outperformer. We'll also be considering Canadian bonds. Canadian economy is far worse position than the U.S. and will be forced to cut. I believe that's true. Looking for Canadian equivalent of TLT. I do not know. I don't think there is. How do you manage your positions in IBKR when assigned? I take them. I have a margin account and I sold puts. I hope I get assigned. In case I'm assigned, I'm okay with keeping the stock for the long term, but I don't want to pay the margin interest. I want my stock to be fully owned within my cash limit. I'm assuming that you would have to use margin if they were assigned. How do you manage this? I don't use margin when interest rates are this high. It would be foolish when interest rates are 0.2%, or when they were 0.2%. Then yeah, go ahead and use margin. It's cheap, but margin right now is not cheap. Do you transfer the position to a cash account? Nope. No, I just don't use the margin. I make sure that I can fully afford it with the cash I have. Do you think we should assess whether S&P is overpriced or underpriced, focusing on Shiller Cape or inflation-adjusted S&P than nominal S&P? I've never used it. From what I see, Shiller Cape peaked in November. See, here's the thing. If no one is using it, or it's not widely used, then it's not widely reacted to, right? If it's not widely used. So I've never used it. I've never, I think I've seen it a couple of times or referred to it, and it's, doesn't really, after the fact, everything seems okay. But if something is going up, let's say something is going up, is that the end? Or is that the end? Or is that the end? And then it comes down, and you look at the past and you say, every time it hit a peak, it came down. Well, yeah, every time it hit a peak, it came down. But was this the peak? Was that the peak? Was that the peak? After the fact, it all looks great. But before the fact, I don't know. Do you? Could it go higher? Sure. When would it stop? I don't know. After the fact, it'll be, well, that was obvious. Yeah, it's obvious after the fact, right? But you don't know before the fact. Okay. Recently watched macro podcast Real Vision. Kem Carson of Kai Volatility. He's an options guy, right? They're a market maker. I know the name Kem Carson. Spoke of the role of vol selling structured products in fueling the rally. If you're a vol person, then what causes the rally is something associated with what you're doing. If you're a growth person, then what caused the rally is something associated with what you're doing. If you're a gold person, then what's causing the rally is something associated with what you're doing. Everybody thinks that what they're doing is what's causing the rally. It's probably a co-correlate. In other words, whatever they're looking at is doing something along with the rest of everything else, and it may appear to be causal when it's just a co-correlate, right? A role of vol selling structured products in fueling the rally. These would be products that offer a fixed yield and sell options on top of it to enhance the yield. Given their popularity now, Ken Carson stated that the sheer amount of option selling due to these products has compressed vol remarkably in equity markets and potentially help fuel the rally. Well, yeah. I mean, I'm not going to say no, but, you know, it's never just one thing. It's not as if, oh, it's this one thing. No, you know, like if you talk to somebody else who's doing something else, they'll tell you it's this other thing. And if you talk to somebody else doing something else, they'll tell you it's this other thing. And all these little things are co-correlates for what is otherwise mostly day-to-day a random walk. A random walk with drift. And everybody's doing their thing here and there. You know, I have a hard time accepting that here it is right here. I've uncovered the whole thing. He's in that space. That's what he sees. And that's what it's going to be. If you were a bill collector, you would think that humanity sucks. You'd say, oh my God, people suck. If you were a cop, after 5 or 6 years, you would get so depressed about humanity, you'd say, they're all just dirtballs and scumbags out there. Because that's what you deal with every day, dirtballs and scumbags. So you see nothing but dirtballs and scumbags, and you think society is falling apart. Right? So you see the world you live in. He lives in a particular world. That's the world he's going to see, and he will make sense of the world he sees based on the world he lives in. That's not a shot at anybody. That's just saying, you know, that's you have to understand that that's the world he lives in. Right? Stated that if rates were to lower, these products may fall out of interest, leading to enhanced volatility while adding potential fuel to a downturn given the dramatic spike. Well, or the other way around, if there is a downturn in the market, these things could fall out of favor, right? I mean, yeah. If you had a protege who wanted to take your knowledge and apply it to institutional asset management, how would you feel about that? I would say that that is exactly what CFA does. It's not my knowledge, it's general financial knowledge that's available out there, but that is what the CFA program targets, is individuals going on to institutional roles, institutional analysts or institutional asset managers. So most of what I say is already being applied at an institutional level, unless there's some other stuff that I'm saying that I'm not aware that's not being applied. Do you think it would work? Yeah, that's anything that I say is not, I don't have a monopoly on anything that I say or any of the knowledge that I have. It is knowledge that among experts out there is widely shared and widely known. A lot of what I'm saying in a certain group, if I were in a room with certain experts, would be common knowledge. Where if I told somebody something, they would say, well, yeah, I mean, duh. You know, I wouldn't need to tell them these things, or the conversation wouldn't go to these things, because I would know that they would know, and they would know that I would know, and we'd know that each other knows. That's the whole idea of common knowledge. So in the institutional world, I would say that if you had a room full of 20-year experts in each of their field, I would be the least knowledgeable person in that room. Yeah. When looking at agency, do they lever the spread over the IG index over the 10-year? Over the 10-year, or do they lever the 10-year treasury yield versus 30-year mortgage rate? No, it is the MBS yield over the 10-year. So if you look at agency, they are short a lot of treasuries because they are long a lot of MBS, and they want to get rid of the duration risk and just lever up that spread. So it's the spread between the MBS and the 10-year treasury. Can you talk about what your thought process would be when looking to exit a position here, keeping an eye on mortgage treasury spreads tightening to 225 to 250? Mortgage treasury, the mortgage to treasury, the MBS to treasury spread. I always point out the mortgage to Treasury because the MBS yield, it's difficult to pin down because these things are issued in coupons of 2, 2.5, 3, 3.5, 4, 4.5, and it really depends on the PSA rate. Exit a position. If the spread did tighten, I don't know that I would exit based just on that. I think I would have to look at the totality of the data. I wonder where I got that from. I would have to look at the totality of the data to make an assessment of what I would do. But no, I don't know that any one thing would say, okay, it's time to go. If DXY will move down, crude oil will move up. Usually, which in turn will negatively affect CPI, which in turn may. We want to say things that are as true as possible. When you say it will, you are making a statement of fact. It will. If you say it may, that's a true statement. It may affect CPI, but there's no guarantee it actually will affect CPI. It may affect CPI. So crude oil may move up, or crude oil most likely would move up, which may in turn negatively affect CPI. That is a more true statement that nobody could then take and tear it apart on you, because you want to write as defensively as possible. And if you write a sentence and I can't tear it apart because you've said, well, it may lead to this, which may lead to that, well, that's true. Now I must answer the causality argument that you're making, as opposed to saying, well, first of all, we don't know that it will move up, and we don't know that it will negatively affect. So I discard your question based on that. Does it increase chances for support from USD? No, not at all. No, zero chance the Fed will be concerned about the US dollar. The Fed will be concerned about CPI, but more about core CPI, not headline. What are your reservations about day trading? It doesn't work. That's my reservations about it. It is the shorter the time period you use, the more the market is a random walk. It is random. It's noise. You're trading noise. To do it, to be effective at it, keep in mind now you're going to be earning the most tax inefficient income that you can get. You are in the business of earning a capital gain. You have been designated a pattern day trader. That's it. There is no capital gain for you. Everything is income. You're in the business of doing that. You have the least tax efficient income. So on an after-tax basis, I would say, I would go as far to say that almost nobody can beat a passive index. It's a whole waste of time for something that you could have done better in by buying something and just getting an education or just getting a job. You could have done better. It doesn't work. I've seen day traders. I went up through the ranks. I did my time with day trading, and you're in groups of other people, and they all fade away. That's why it's called day fading. When there's a term for something, there's a reason. There's a term for something. They all lose their money. A few survive. But the odds say a few will survive anyways, right? I've been selling premiums, safeguarding my capital, outperforming SPY by 3 to 5%. That's not day trading. I'm growing frustrated. A friend recently earned my annual salary in just 15 minutes. Great, they showed you one winning trade. Now ask them to see all their other trades and how much money they've lost, and are they truly way ahead based on all the money they put up and lost. Yeah, sure, you could have a big payday one day. When I was day trading, I had big paydays. I shorted Sharper Image. Oh my God, this thing was a piece of garbage. $18, Sharper Image. Do you remember Sharper Image? Probably not, but Google that thing. I shorted Sharper Image at $18, and I went in heavy at $18 before earnings. I mean heavy. Next day it opened at 13. I made a killing. and then the next day you give a little bit back, and the next day you give a little bit back again, and then you make some, and then you give it back, and then you give it back, and then you make some, and then you give it back, and then you give it, and that's the way it goes. So had I just walked around saying, look what I did, it'd be like, oh my God, I got to get in on this. But really, it's you looked at one specific trade, one outcome from this person. I would say look at their whole performance and see if that still is the case. Let's see. May I kindly ask you to elaborate better the desire to buy MBS due to current conditions? For example, the spread of U.S. 10-year and 30-year FRM. So it is about 300 basis points right now, which is about 100 to 125 basis points more than what it normally is. And these spreads are mean reverting. Now, that's not the spread from MBS to the 10-year. That's the spread from the fixed rate, 30-year fixed rate mortgage. If we read agency statements, they tell us that the spread between MBS and the 10-year is exceptionally wide, and they make that point because they're reinvesting at those higher yields. That spread will decrease, and the 10-year yield will decrease. So as rates drop, the Fed says we'll do it 3 times, the market says 6 times, but as the 10-year rate comes down and as the spread contracts, each one of those are supportive of price appreciation. Well, that's why. So impressed on how you close your short beta position during the year. Such a good move in the end. Not really. I closed it in July at the height of the AI frenzy, probably a day or two just before the market said, you know what, we don't believe it, and then started to retreat. So it wasn't great timing. It wasn't great timing at all. Thinking of organizing a finance retreat anytime soon. I would totally be in. Yeah, I thought about that. I thought about, having a 1 week, intensive review session at the house, but I could only have 4 people. But that would be really great, a 1 week intensive review session for a level 3 just before the exam or a couple of weeks before the exam in Costa Rica. I don't know. I don't know yet. It sounds fun. I think it would be fun, but there's so much to plan on doing something like that. So as we get close, can't be February, it's too soon. But as we get closer to the August exam, yeah, maybe try it out. A while ago, you shared UBS bubble index in Toronto is at around 1.25, but every year since 2017, Toronto has been at bubble level. Yep. But prices kept increasing from 17 to 22. Why is it less of a bubble now, even though price increased from 17? You have to read the methodology of how they calculate what something is a bubble. Let's say that prices of something were $200 and skyrocketed to $600. You would say, that sounds like it's in bubble territory, especially if it happened over 4 years. A tripling of price in 4 years, that's bubble territory. But what if wages went from 50 to 500 over that period of time? You see the difference there? 50 to 500, suddenly this is not really such bubble territory. So you have to look at wage gains at the same time that you look at house price appreciation. And you got to look at wage gains. So they measure bubble territory by the affordability of the property. And even though the price of the property can go up, if the affordability drops, meaning that your incomes have gone up or that the incomes in the region have gone up at the same time by maybe a higher rate than price growth over that period of time, then suddenly it has become more affordable. So that is probably why it's dropped. And I think they do make the point of saying that. Since you left Canada, what's your view on Toronto home prices next year? I can only go with, I think it was Royal LePage put something out that I kind of agree with, is that as rates start coming down, simply because of the shortage of housing, even if houses do come onto the market, the rise in population has been so dramatic that you'd have buyers coming in once mortgage rates drop, which would be very difficult for prices to drop in that kind of environment, that prices may actually eke out high single-digit returns next year, 7, 8, 9% growth. I don't know about the 7, 8, 9%, but I can't see house prices falling given the structural shortage that exists and the absolute desire of the Liberals right now to import as many votes as they can because they are behind in the polls. And new immigrants tend to vote in line with the party that was in power when they arrived. They tend to vote for the same government because that's the government that let them in. So if the Liberals can't get enough votes from domestic sources, they can import their votes. And they are massively importing their vote. And Trudeau's not going anywhere. He's not going to call election until 2025, and he will try to import as many votes as he possibly can, regardless if there's housing, because he is very much like Trump. He loves power. He's not going to let it go, and he's a raging narcissist. He doesn't care about you. He cares about himself. It's brand Trudeau. It's not brand Canada. It's brand Trudeau. He doesn't care if they can afford housing. He doesn't care if they can afford housing. He only cares about getting reelected again. So I cannot see house prices dropping when you have two forces in opposite directions. Massive increase in population with no place to live. The housing that's coming online is not happening fast enough. Something has to give, and that's going to be prices going up. Regarding remote work, what's your take on this? It's not a thing. Effective workers are going to be effective regardless of their surroundings. Workers that slack off are going to slack off regardless of their surroundings. That's not really true. You are disregarding a network effect in there. Is that I'm effective, but if you put me in a room with 10 people like me, I become even more effective because I'm competitive. Effective people are competitive, and if you put them together, they become even more competitive. And not only that, I'm effective only at the speed at which other people can be effective. And if I have to wait for an online meeting at 2:30 this afternoon when I got a brainstorm at 11, that's not going to help me. If I got a brainstorm at 11, I want to turn to somebody and say, "What do you think of this?" Right? Now, I'm effective. But if you put another person like me with me, we have an emergent property in the sense that I have an idea and they have an idea and their idea informs mine, and I say, oh, but hang on, yeah, well, we combine it and have this, and then they say, but we could do this, and we end up getting to a better place. So you lose the emergent property. And all you have is a decomposition of the parts. So you have a person here, 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 and the organization is the sum of these people, is the sum of all the strengths and weaknesses. That's all it is. It's just the sum of it all. And you think, well, of course it is. But with a group, when they're co-located and they can interact spontaneously, you get an emergent property at the whole that you cannot decompose to the parts. Let me give you a good example of that. Hydrogen is a compressible gas. Oxygen is a compressible gas. But when you bring them together, you get an incompressible liquid. Now, the property of being an incompressible liquid cannot be decomposed to the parts. It is a property that only happens at the level of the whole. That's called an emergent property. When you have a team that is not co-located, but that is dispersed, you have a team that is the sum of the individual parts, nothing more. 2 + 2 = 4. But when you co-locate them, you get something extra that you cannot get, something that you can't decompose to the parts. You get an emergent property. You lose that. Not only that, you have, from network theory, there is a theory of mutation. I don't know if it's called a theory of mutation, but the concept of mutation. So let's make our network a little bit thicker, and we're co-located in an office with a bunch of people. And there is certain properties that each one of these units have, except this one, except this one, except this one have a different property. They have a probability of, because of their mutation, let's say that they're high performers, they have a probability of infecting the nodes around them. And these nodes can sometimes flip to high performers, which then have a probability of infecting those around them. This is called culture. This is called company culture. That is lost when you have a dispersed organization that all work independently. You have an idea of what a culture is, but you have a whole bunch of individuals. You don't have any individual that understands the emergent culture that exists beyond what they are. That is lost. The idea of a mentor, the idea of you can get a certain type of behavior replicated if other people can see it. For example, if you're in an office and it's 4:30 and you look around and no one is getting up, you're not going to be the first to get up. It's 5 o'clock and no one is getting up. You're not going to be the first to get up. That's something that is lost inside in the home. You may say, well, that's a good thing. Work can't be your whole life. Well, then that's fine. You do have two groups of people out there, those who have decided to trade hours of their life for money. That's fine. And you always need these people. But then you have others that decide to trade ideas for wealth, right? And these are the ones that rise to the C-suite. They become your CEO, they become your COO, they become your VPs, etc. They have stock options, and they rise to the top. It is a competition. And I'll tell you something, these people here don't feel like they've given up their life to the company. They feel that the company and the work has brought meaning to their life. There are two types of people. If you are working individually at home, these other people who don't have that property have almost zero probability of becoming infected. Zero probability of saying, you know what, I'm seeing everything in a different light. Zero probability. That is lost when you work at home. There's a short answer. Would love IPPs, unregulated utilities. Okay. I'd like to hear your thoughts between two strategies, buying VIX calls on SPY. VIX calls on SPY. Oh, sorry, VIX calls or SPY put spreads. SPY put the SPY put spreads will be better for you. The calls on VIX. VIX is not a no arbitrage futures price. It is sentiment driven, which means that it can be the futures price can be significantly higher than where the spot is, and your calls are based on where the futures price is. So you'd have to buy a call higher if you want a lower price, to the point where volatility may never actually rise to that level. For the call to even have value, it may never even hit the strike. So because of that, you would have to be absolutely certain that volatility is going to spike. Absolutely certain in the short term, because you don't want to go out on that futures curve for VIX, especially if it's in contango. So I would be doing put spreads on SPY if I were going to bet on an increase in volatility. And if I were betting on an increase in volatility, I would just buy the put. So if I were thinking, well, the market's due for a pullback, then use a spread. But if you think, no, the market's not due for a pullback, but it's due for a massive sell-off, and volatility will spike. If I'm playing volatility, I don't want to buy and sell volatility. I just want to buy. I just want to be long the put. You stated you aren't a huge fan of technical analysis. Do you think any other statistical analysis, moving average, autoregressive moving average, Bayesian times, past price returns? Well, I mean, any time where you've decided to ignore everything else and you're really looking just at past pricing or past volume, that is technical analysis. are valid or useful tools in forecasting trends in future prices? Nope, I don't think they are. Does the CFA cover any of these topics? Time series, level 2, it does introduce ARIMA strategies, but it's not a testable part of the reading. I don't know whether it will or will not be a testable part of the reading, but in FRM it is introduced and it is testable. No, I don't use any of that stuff. Look, here's what it comes down to. We know the structure of DNA. I mean, we know the structure of DNA, but we never used to know the structure of DNA. Here is the wall that is hidden, and here's the truth. There is some truth. This is called an ontological truth. Ontological because it actually exists, right? So that we can discover that truth, but it's hidden from us until we discover it. And methods are developed to try to discover it, and maybe one sees this, there's nothing here, there's nothing here, maybe one sees this, maybe one sees just a part here, and in time we realize, well, these are the better methods so far, and then another method gets another method, finally hits it, and when that method hits it, all these other methods go away, and we have a methodology through which we've arrived at ontological truth. That's how you know there's something there, when the truth is directly proportional or inversely proportional to the number of methodologies used to discover it. Which means if there is one method to discover it, it's truth. However, when you have hundreds of methods, and that's what technical analysis is, it's just hundreds of methods out there, then there is no truth. There is no ontological truth on the other side called forecasting stock prices. Because if there was, there would have been a hit. There would have been some methods that hit it to the point where you eliminated the other methods, where there was one or two really big ones that were there, because there is some ontological truth. There is some truth to be discovered. But if there is no truth to be discovered, you will have hundreds of possible techniques to discover that truth, which means there's nothing there. There is no ontological truth. There is no ontological realism behind what it's looking for, which is to forecast the future. It is unknowable, unforecastable, nothing you can do, period. So all of this lines on charts and all of these really extensive quantitative techniques to try to predict the future, flip a coin. If you can, whatever you develop to predict the future, put it up against a coin flip. And you'll find that over time, your model is just as good as a coin flip. That's all. It's just as good as a coin flip. Canadian CPI was very much sideways last month. Shelter was a big reason for this. Could TIFF have, could TIFF have known this before Friday's commentary? I don't think so. Sometimes they can sometimes they have an advanced knowledge of some numbers, at least if we're going with what the Fed has said. Powell did admit that before, that sometimes they get an advanced look, but not really. They don't know much more than what the market knows when the market knows it, but sometimes when it's critical. I don't think this would have been critical enough for him to have had an advanced look at it, so I would say no. I'd love for the CAD to give back a little soon. I don't want it to. I want the CAD to get stronger and stronger, because I am in the process of converting my Canadian into US, but it's so slow. Oh God, it's so slow to get it done. You can only do, because I have to transfer it into Interactive Brokers, and there's so many limitations on how much you can put in at the same time. I want to get it all in on one account and then transfer one account at one time. But it's so slow. It'll take me, I think, 28 days to get it all done. So I want the Canadian to keep getting stronger. Could you kindly explain why a consistent decrease in real already did that? Man, you made it. Really proud of you, Mary. Thanks for the comprehensive analysis. And Mary Ho Ho. Can you talk about ways to play the Canadian housing market if the Fed cuts rates next year? Well, you play the Canadian housing market if the Bank of Canada cuts rates. Except REITs as they tax inefficient for a person outside of U.S. Canada. There aren't many good ways to do it. Unfortunately, there just aren't many good ways to do it. But if there was going to be a nice healthy housing market, in other words volume increases, then you'd play it through the banks, the Canadian banks, because Canada doesn't have a very robust MBS market. In fact, I don't think it has an MBS market because of the nature of our mortgages, meaning that the banks hold them. So the banks would tend to do very well if the mortgage market really did well. View looking like a desktop background. Sublime. Well, that's good. Could you please describe mid-20s Mark with a series of adjectives? Whew, series of adjectives. Mid-20s Mark. Bright. And I'm not saying that to brag. I've always known since I was in kindergarten that I was, number one or number two in every class I was in terms of grades, and it was a source of identity for me. I that was a big part of my identity, is I always knew that I had that. So, in university, getting less than an 80 would be a loss. That would hurt. So I was always academically inclined. I was more alive learning than anywhere else. I loved school. I never, ever wanted to leave. I loved it. But personality-wise, immature, I would say is a good adjective. But you might say, yeah, well, what 20-year-old guy is not immature? I would say that I lent more towards the immature side than most did. I grew up with a grandmother, right? An alcoholic grandmother, which I didn't find out till later. She was an alcoholic grandmother. When I found out, it was like, oh, that explains so much. Oh, if only I had known that earlier, I could have joined in. But no father figure. And, it never bothered me as a kid, but you recognize in your 20s how much more mature other guys in their 20s are to you who had that. And you recognize that and you think, well, it must have played a role. So immature is one. I'd probably say with immaturity comes selfishness. That would be another one I would describe myself with, selfishness. But confidence that my future was going to be brighter. I always had that confidence. I always knew that I was going to have a good future, even if the present moment I was in, living as a student at the time, was like, this sucks. But yeah, I think that's almost any mid-20s. You're going to get immaturity and selfishness, I think. Yeah, I think those are good adjectives. How can I, as a retail investor, take advantage of decreasing spread between 10-year USD and 30-year FRM? You would need a dealer because MBS is a dealer market, and I believe there probably are certain minimums, and you would hold MBS or hold one of the mortgage REITs. How are you positioning your portfolio going into 2024? Well, I'm not. I'm going to have an external manager take care of that. But I am becoming more interested in property because I do think that because of the structural shortage, this is something that cannot be solved in the next 10 years. Not only that, I don't think that immigration, if you're going to be nearshoring, if you're going to be bringing the supply channel closer to you, you need more workers, you need more immigration. You can't build houses fast enough. You can't. So I see a multi-year run for housing. I see multi-year run, especially in Canada for apartment REITs, because there's just no better way to play it. In the U.S., I think the housing stocks continue to perform. I think the housing supply stocks, look for companies that sell roofing tiles. Look for companies that sell the air conditioning units. Trane is the big one. TRANE is the big one on that one, because every house needs one, right? So there's a whole bunch of ways to get into the property market without actually having to buy the property, that I seem to think that if I had to make one big bet, it would be North American property, through Canadian apartment REITs, through the U.S. home builders, and through some of the home construction suppliers. Would be curious to know your current split between fixed income and equities. Right now, it's all fixed income because I have to transport money across the border, and it's, you can plan as in advance as much as you want, but everything takes longer. Everything takes longer to do. And there is no rush until January 18th, because up to January 18th, I am a Canadian resident, subject to Canadian tax. So there's no point in rushing the money out of the country before January 18th, because wherever it goes, it's going to be taxed anyways, right? But duration has been a big... Beta sucked for the first half. Well, not for the first half. For the first quarter of the year, I did very well on beta. The second quarter sucked into July. The third quarter was nowhere with duration. It looked like I got out of one bad trade into another bad trade, but then it just exploded, and duration has been beautiful, and I think duration will continue to perform well into 2024. Equities, I'm not too sure of. There's a coin toss, but certain pockets of equities I think will do well. But if I had to pick beta or duration for 2024, duration. Hands down, duration. With Canadian inflation coming higher than expectations, does this change your thesis on Canadian bond yields? Nope, does not. Which you viewed as a favorable investment. Do you think CPI results mean higher for longer? Nope. As I said earlier in this video, Tiff has already said he expects to start cutting rates in 2024. I mean, he's basically said it. Now, the Fed hasn't even said it. I mean, the SCP points to 3 rate cuts, but Powell hasn't actually come out and said we are cutting rates in 2024. Tiff Macklem has. So there it is. Seems like a hard landing is more likely in Canada. More likely than US? Yes, I agree with that. Given the sticky inflation, very interest rate sensitive consumer. Yes. Have you introduced those certificate of achievement badges yet? Not yet. It is, how can I word this in a diplomatic way? It is not entirely something that is in my control. there, that's about, let's leave it at that. Open mouth operations, pure gold. Yeah, I can't take full credit for that. I can take credit for using it at the right time, in the right context. But I forget who called it open mouth operations. I heard it years ago. On I think it would have had to have been Bloomberg, because that's all I really listened to. Wouldn't have been CNBC, but I remember hearing at the time saying, that's pretty good, open mouth operations. So it's not mine. It's not. I didn't say it, but there it is. There is quite a debate right now on whether all those trillions sitting comfy in MMFs might or might not serve as fuel to risk assets as rates drop through 2024. What's your opinion? Well, it is elevated. It is elevated, and yeah, it's going to be fuel for something. Because as soon as rates start to get, as soon as you get the first rate cut, money will flow out of that. Money will. Because investors will recognize that they're holding an asset whose return is going to decrease over time while they watch every other asset increase. So money will move out of there. But you need the first push out of the nest, I think, to really get that ball rolling. Also, 7% deficit to GDP. It's as far as the eye can see, right? I mean, like it's almost as if politicians are either oblivious to it or simply don't care because all they care about is getting reelected long enough to get their pension and screw you. Long enough to get their pension, long enough to get a book deal, long enough to get on the speaking tour and screw you and screw your kids. But yeah, deficits as far as the eye can see, plus the beginning of the rate cut cycle might serve as a tailwind for both corporate earnings and valuations. I can't argue against that. Therefore, tailwinds for S&P 500 through 2024. Well, there will be tailwinds and there will be headwinds. You've identified the proper tailwinds. Now, I want you to think about what the headwinds would be, right? If you have inflation coming down, you have a source of revenue growth that disappears. And if you have these deficits that are happening, you have potential higher taxation in the future. So you have to think about, well, what are the headwinds as well? How reverse repo relates to Fed balance sheet? Well, it's a source of cash, right? So the Fed gets cash from that. So you have money market funds that need to put cash somewhere. They can do repos with dealers as well. They don't have to go through the Fed. It's just with the Fed they get a rate. If they don't like what they're getting with the dealer, they can go to the Fed. So cash flows to the Fed, and dealers go to the Fed for repos. So cash goes to the Fed, and then cash goes to the dealers. Securities come to the Fed, and security goes to money market funds. So they're sort of funding each other, and the Fed is just acting like a middleman. So if this went away, well, you can see what happens is the Fed would then have to start putting up its own cash. Because it wouldn't have the use of cash from money market funds. But dealers and hedge funds, they can still enter into repos with each other. They don't have to go through the Fed. But if the reverse repo disappears, then it is a source of funds for the Fed, and it's a conduit to offset securities that it may not want to hold from the repo side. So what's going to happen? I don't know. We'll see. Ray Dalio recently warned that U.S. debt service is reaching a dangerous inflection point. In a video from 2021, you talked about debt not being much of a problem at the time. With low interest rates, debts are not a problem. 6 months ago, you did an interview where you pointed out the growing U.S. debt to fund operational expenses was becoming a problem. Yeah. What is a problem is not the debt. The debt is not a problem because that can be solved. The interest cost on the debt is not a problem because that can be solved. They are, I wouldn't call them problems. They are concerning. Let's use the word concerning, right? The debt and the interest on the debt is concerning, but they can be solved. You can balance the budget. You can use fiscal policy more judiciously. If you did that, you would take a source of spending out of the economy, which would reduce inflation, which would then reduce rates, and reducing rates would boost growth. And if you boost growth, you increase the size of the tax revenue. It can be solved. It is not a problem. It is concerning. What is a problem is politicians that do not recognize that this is concerning. That's the problem. That's the debt problem. The debt problem is not the balance you have. It's the person holding the credit card that's the problem. Once you take the credit card away from the spender, the debt can be solved. The problem is the person holding the credit card. The problem is the politicians that do not recognize that this is concerning. That's the problem. It's not the debt that has to be solved. It's these people that have to be solved. It's the absolute willingness to deficit spend without flinching as far as the eyes can see, with no desire and no plan to balance the budget. That's the problem. That's the debt problem. Not the level of the debt, but the people who are responsible for controlling the debt, who have abdicated their responsibility in the name of selfishness for power. That's your problem. I say your problem because I don't live in the Canada, in the Canada. I'm speaking like a foreigner. I don't live in the Canada. I don't live in Canada or the U.S. anymore. Not my problem. 2023 forecast was spot on. I don't even know how things are going to look at the end of January, let alone the yeah, I guess if I say I have no idea where the market is going, I will be spot on at the end of the year. You said you didn't know, and my God, here you are. Do you feel more confident with your top-down approach heading into 2024? I don't feel very confident with beta, but duration I think will perform well, which means utilities will perform well, and I think housing continues to perform well. Yeah, I think Canadian REITs continue to hold up. Outlook on oil, Oxy and DHA, please, in the next 6 months. Oil's a tough one to play. Oxy, I don't know that I would look too much at the price and the multiple as much as the free cash flow yield. I think at 15%, it's always going to be a buy, which means 57.50, 55 puts. I've never gone wrong with them. Never. Also had a question: if a stock price moves below the exercise price, can it put to you before expiry? The higher the interest rate, the more likely that would happen. Yes. And what if you don't have the funds to buy at that time? It would be assigned to you and immediately liquidated. Like, it would be assigned to you overnight, and then the next morning there'd be a forced liquidation, and that would be the end of it, which would be equivalent to you having taken the loss the night before it was assigned to you. So it's not a big deal. It would just be forced liquidated the next day. In the Brookings article, high mortgage rates are probably here for a while. I read that the 30-year FRM and 10-year spread is made up of the following components: primary, secondary spread, prepayment risk, and duration adjusted spread in the OAS. Would you mind explaining why the prepayment risk is at its widest? Well, when interest rates are really high, prepayments are really slow. Okay, great. As interest rates drop, prepayments increase. You may get your money back right when interest rates are dropping. So you buy something with a 7% yield, interest rates start dropping, and you're getting the 7% yield, you're happy, boom, you get paid out. Because prepayments increase because people refinance their mortgage, or they sell their house and they buy another house, and that pays off the existing mortgage, and you get all your money back at lower interest rates. It's like, damn it, I should have stuck with the 30-year treasury. I had to go ahead and reach for yield. So the danger when rates are high coming down is your prepayments are going to increase, and you'll get money back right when you don't want to get money back. That is a risk. Are the issuers cautious of the future drop in rates and prepayment? No, issuers don't care. The issuer is not going to be too concerned. It's the investor that should be aware of what the risk is, not the issuer. When you say you will move into MBS if TLT is called away, do you mean buy a fund? No. That aggregates MBS? No. Buy it directly. Yeah. Please add railroads. I wonder how one can deal with FOMO. I watch Bloomberg every day and stay in touch with the current market, but I feel they are the biggest FOMO inducers out there. I want to stick to my investment thesis. I don't want to buy into the current market with its current valuation, but it's hard seeing this market mania everywhere, even at my workplace, and not feel bad. Do you have any tips on how to deal with FOMO? Well, it all starts with what's your goal? What are you doing this for? What's your investment horizon? What targets are you trying to reach over what time period? Start with why are you doing this, right? So I may say, look, I go to the gym because I want to maintain a certain muscle mass and a certain look and feel, but I'm not really going for the heavy lifting anymore. Though that was in my younger days. That's gone. But when I go to the gym, I still see guys benching 350, 365, 370, squatting 410. You still see it. It still goes on. And there's a part of you that says, I used to do that. Maybe I could do it again. You don't want to seem like you're doing less, but then you think, wait a minute. That's not my goal, though. Even though they're doing that, they're not my benchmark. That's not my goal. And you got to keep reminding yourself, that's not my goal. I don't need to do that anymore, And so think about it the same way. What's your goal? What are you doing this for? What are you in it for? What's your investment horizon? What plan have you got in place? And you work your plan, right? Like Warren Buffett in the late 90s was criticized because he did not get involved in the dot-com boom. Didn't he? He knew what his game plan was. He knew what he was doing every day. He knew what sandbox he was playing in. He said, that's not my game. And, there was, at the time, a growing chorus of, well, he's a dinosaur. He's outdated. He's not going to survive in the new economy. And yes, he did. And he's still around today, 24 years later, still the king of the hill, right? So figure out what your sandbox is and stick to your knitting. Don't worry about people around you. They have different strategies and different goals than you, perhaps. Just let it go. So probably a good book to read from the 80s is I believe it's called the way of the tortoise or the way of the turtle, and it was about this experiment of I forget what it was about, but it was about having a strategy of slowly and surely, and over time it was the winning strategy, always the winning strategy. And I believe a number of hedge funds were spun out of that whole concept of the way. I think it's called the way of the tortoise or the way of the turtle or something. If somebody can remember it better than I can, go ahead and put something in the comments section. But I think a couple of really famous hedge funds were started by disciples of that experiment. Are you doing another hat drive philanthropy event? Well, it's not mine to do anymore. I don't think there is one going on. No. Questions on IBKR interest payout. I understand that they don't pay interest on the first 10K. I had 15K. I get interest on 5. Well, if you have, you should be in T-bills. If you just have cash sitting around, put it in T-bills. You can find a 5-day T-bill, a 4-day T-bill, an 11-day T-bill. You can find them through Interactive Brokers, and they're super, super liquid. Sit in a T-bill. If you need the money, you can sell it the next day, and being that it has no duration, it will simply just get pulled towards par. You'll make the interest every day. Do you think that the inverted yield curve doesn't mean anything anymore? Well, we always say that. How many times have we heard this time is different, only to turn the corner and say, nope, it's not different this time. It's the same as last time. It just doesn't look the same, but it's the same. And I don't know which famous hedge fund guy said, or maybe it was Warren Buffett. He said the scariest words are always "this time is different," because it never is. It never is, and we'll avoid a recession. Only time will tell. I don't know. I don't have enough visibility. I would say, if I had to bet now, red or black, I'd be saying no. No, I don't think it's any different, and no, I don't think you'll avoid a recession. If I had to pick one right now, I'd lean more towards that. That doesn't mean I'm 90% there. It just means that if I, gun to my head, pick one, I'd say no, it's not any different this time, and no, I don't think you'll avoid a recession. Can you review infrastructure asset manager companies? What are your thoughts on MREITs given this? Okay, I've already answered that. How's Costa Rica been thus far? Challenging. Do you know Spanish, or is there certain? I use Duolingo, and the progress is really fast. I'm my staff speaks Spanish, but we have these, you speak into your phone, and then they speak Spanish, and I can read the English. I speak English, and they can read the Spanish, but it's not perfect, because sometimes they say things, and I read it, I go, what the hell is that supposed to mean, buddy? And you got to take it with a grain of salt, saying, I don't think you meant to say that. And sometimes they read something I said, and they look at me funny, and I think, oh, well, did I just threaten to kill their son? So, but I am getting to the point where I may not have the full sentence, but I can get the words out that I need to get out, that they understand what I'm saying and what I'm asking, and I am on Duolingo every day for about an hour, and every day you're adding more and more words to your repertoire, right? So yeah, I'm getting there. But if you want to have fun with a new language, try Duolingo. The first, I think, six lessons that you go through are free, and then you buy one of the plans. I think I spent, I forget how much I spent. It was 14. Once you buy, it's 14 days for free before you cancel. I think it's $199 lifetime, and you have access to all the languages. But I could be, 2 years just going through the course, the Spanish courses that they have. So I tried Rosetta Stone. Ugh, no. Compared to Duolingo, Rosetta Stone is like, it should be out of business. Good move getting out of Canada. I assume in your other video you'll be touching on the myriad of problems Canada seems to be facing right now. Yeah. Next question. I remember you talked about the cost of building homes in Canada in a video, and you mentioned the cost of building road because builders need to buy the land, build the road for free, and build the home. Well, it's not as if it's called an easement, right? You buy 25 acres and you're going to build some homes. The city says, okay, we're not building the roads. You got to give us some of your land. You got to give it to us. That's an easement. You lose about 30% of your land. And you do have to put in the roads. You have to put them in. They don't come in and put them in for you. You got to put them in, and yeah, you lose about 30%. If you're building a development, you're going to lose about 30% of your land. That's called an easement. That's everywhere. At least everywhere I know of. I tried to find the video. Yeah, I don't think I said it in the video. I think I said it just in the market update. I personally wouldn't choose Costa Rica as taxes are not the only thing that matter. No. But the things that matter to me aren't really dependent on the country I live in. They're the most important. You mentioned you get bored sometimes. What about getting a dog? I'm not settled yet. I still have to go back to Canada for a month, and I have to come down here. And I do have an opportunity with this place because it is such an iconic place. I say iconic. It's. I wouldn't say, maybe let me change the word. It's got presence. Like when you come here and you walk through the house, just the way it's built. One part, when you walk in, the whole front of the back of the house, not the front, the whole back is all glass top to bottom, and all you see is the mountain range all the way out. It is absolutely stunning, and because and it has green spaces in layers with stables. Like it slopes down a hill, so there's all these different sort of plateaus on the way down with green spaces. It is an event place that if you were going to host a weekend party or a wedding, it is a great place for it because of the sheer amount of parking, the chef kitchen, and just the size of the property. This month there's 2 events that are happening here, and there's a bunch of events that could happen for January if I want to, and all of February because I'm back home in February. So it turns out the earning potential of this place is huge if I turn it over to a management company. So I may look at this as an investment, and I might not actually live here, but then just find another place. I might. So I won't get a dog until I'm settled. Is there still time to go long TLT despite the dramatic move? Yeah, I think so. TLT is made up of long bonds, long duration. I think duration still has a winning year in 2024. Curious to hear if your thesis of something significant in the economy breaking is still top of mind. Usually when rates are this high for this long, something somewhere breaks. And that's usually with a good economy, something somewhere breaks. And usually it just happens all at once. It's an exogenous event. They're usually hard to predict. When they're endogenous, there's usually some rumblings. The only rumblings we're hearing is commercial real estate. So if something happens there where there is a fear and credit begins to tighten up, that could be a problem. But the Fed has already shown itself willing to supply all the liquidity that's needed. So a repeat of 2008, 2009 for property is just not going to happen. It's going to have to come from somewhere else, and I just don't know where. Second question, no need to share specifics. Is that gorgeous house of yours more expensive than a Toronto shoebox? Looking at you, new development project selling at $1,100 per square foot. Oh my God, this is per square foot. I'm way, way cheaper. Oh my God, I can't even tell you. Down here, you can build a house probably for about, they do it by square meter, right? So it's like 1,400 a square meter, and you divide that by 10.88, you're at about $130 a square foot US. So you're about 160 a square foot. You can get significantly and better quality build. I can't even begin to tell you. Better quality build, better material than you can in Canada. But yeah, you can get for what you'd get a 400 square foot condo for in Toronto. Here, converting it to US, you could probably buy a 5,000 square foot house. So in a condominium area, meaning in a gated community. Do you have any particular individuals who you listen to for info? I wish I had more. They're so hard to find. They really are. I mean, on YouTube, there's the regular group that do the tour. You know, this person's on this person's show, and then this person, that person. They all have their own channels, and they're all on each other's channels. It's always the same names, always saying the same things with the same thesis. I listened to him for a while ago. Okay, I I'm done. No, I don't have. I wish I had more. If you know of good sources, please send it to me, because maybe YouTube in my feed just isn't allowing me to see more of the universe that I should be seeing. It's a way to tell how much of the 11.55 billion withdrawn from money markets went into S&P, pushing it to higher levels. Yeah, there is information weekly, ETF fund flows of what's going into what ETF. There is that. You can combine it with that, but it's messy because you don't know where it came from, right? So, do you reckon you're a lifer in Costa Rica? I don't know. Move back to Canada? No, there's nothing there for me. There was nothing, like, I didn't leave anything. No family, no friends, no significant others. So there was nothing there for me. So there'd be nothing drawing me back. How can you see interest payments on IBKR? Click on, I forget what it is, but yeah, I forget the name of it. It's like the third icon over from the top when you're on the main screen. Account viewer, and I think right at the very top, the first panel, the last line will tell you how much interest you've been paid. Well, look at the gain in lumber prices. I just kind of shake my head at the move in home builders, being this is by far and away the single biggest input cost they have. So if you read the actual statements, so DHI, D.R. Horton, they're a home builder. They design the home, they get the land, they service the land, and then they say, these are the homes we want built. They'll find a contractor, and they'll quote it out to a contractor, and that's it. The contractor has to come in for that price. It's the contractor that has to worry about the lumber prices and fluctuations in lumber prices. So it's those kind of variations or variabilities are hedged out by going to a contractor that says, we'll build all 40, here's the price per square foot, and here's our delivery dates that we'll deliver by. Okay, done. It's the contractor then that is responsible for managing the costs. If there's cost overruns, that's not the home builder's issue, that's the contractor's issue. So it's, it's not anything that is a risk would be hedged out. So we'll just pass on the reading of that. I think I got the gist of it. Any explanation why Companion Apartment REIT sold off last Friday? Yeah, because Meldrum said at that time, I'm not even thinking about cutting rates. And then this week he said, yeah, I'm cutting rates in 2024. But the other issue is apartment REITs ran so far, so fast, and they had a blow off top Friday morning, which means if you watched the price action Friday, they went straight up, they went parabolic. That doesn't hold. That was a bunch of short covering right at the very top. At least that's what it looked like. There was bound to be a retracement. And they're retracing, quite a bit, which I'm more than happy with, because I took my profit last week when they had peaked, and I said, look, I made this much in this short period of time in my registered accounts. Why not take it and move back to cash? That was a nice return in like 6 weeks. Super, 30% in 6 weeks. So I took it. Now I'm seeing them retreat again. It's like, okay, well, I'll do it again. I'll do another round trip, but not yet. Let's see where they get to. What hardware and software do you use for writing on the screen? I use a Cintiq 13D, and I use a sketchbook. However, I have been shown something on the iPad that works just as well. I haven't adopted it yet, but it works just as well as Sketchbook. And your iPad hooked up through the UBS cable is just like a Cintiq. So I may migrate at some point away from Sketchbook and away from the Cintiq. I may. I've just gotten so used to doing it this way. Can we finally admit valuations don't matter? I don't know about finally, but can we admit valuations don't matter? Yeah, well, it depends. Don't matter for what, though? QE infinity is the new normal. Once rate cuts happen, there's nothing to stop this rallying. Also, that is not a house. It's a hacienda. Hacienda. Okay. I don't know if I'll be able to get through the rest of the comments. There's just so many of them. So let's just do a couple more and we'll tap out. You mentioned the applied series access included with the CFA package doesn't expire. I recently lost my applied series access from my 1 fee to completion CFA package from a couple of years ago. So a couple of years ago, there was no applied level. There was an applied series, which was just a series of videos I was doing that was applying the concepts of CFA here and there without any real strategy to it, just here and there. Yeah, you would have lost that. That's the applied series. The applied level is a different thing altogether. We suspended the 1 fee to completion years ago. Way before the applied level was available, so you actually didn't pay for the applied level. You paid for CFA and you got applied series content for free, but it was again just videos here and there with no real theme driving all of them. They were just opportunistic. And let's say the market is pricing in X number of rate cuts. Can you explain how they're calculating that? Is it a Gordon growth model? No, it's just a price. You just look at the futures price, and the futures price is 95.5. That implies a rate of 4.5%. And if the current rate is 5.5%, there's 4 rate cuts. That's all it is. That's all it is. Incredible to theorize what a house that size and that many millions would cost in Canada. Yeah, it would be with the way that it was built. 14,500 square feet on 6 acres with horse stables. Upwards of 12 million, 15 million Canadian, right? In the past videos, you mentioned that you don't have any children. Nope. What will you do with your assets? They are all designated for a university, for a research chair. Let's see. Did you also buy the horses? No, I did not. They're still the previous owners who part of the purchase price was the rental of the stables till the end of February. How can I benefit if I think the market has overshoot the rate cut estimations? You would short the federal funds futures, and you'd probably do it for December. Do you think BOJ could surprise with a raise? New York Fed extended. Not sure what all that is. Well, they didn't, so I don't know that it's not fair for me to say no, they won't. They didn't, so it wouldn't, yeah, they didn't. Have you read Charlie Munger's Poor Charlie's Almanac? Nope. Added CFA level 1 access. I thought when I was done with CFA, I would lose both contents. Can I upgrade for 320? Yes, you can. Why is it risky? Already answered that. Alternative to TLT, already answered that. Fair to say you're cautious about 2024 earnings. Cautious is a good word to use. Most companies with exhausted accounting tricks and comps will be comps will be tougher, especially without the ability to raise prices. What is the basis for saying that yields were too high when they hit their cycle high? Because it's a risk. It's a default risk asset, a default risk-free asset. I mean, when you're getting for the 2048s 25-year bonds, you're getting 5.5, 5.6. It's like, who's not taking advantage of this? What institution who needs yield for the long run is not taking advantage of this? It just didn't seem to make a lot of sense. Okay, I know there are more. I just don't have the time for it, so we will stop here.